Hello, everybody. My name is Christian Winkler. I'm heading the Markets Infrastructures Investors Unit within ESMA, which is basically a team of analysts doing financial stability analysis. And today, like in this context of financial stability analysis, I'm going to talk to you about the money market fund regulatory framework in the EU. What I'm going to talk to you about is basically like the following topics. First, so why are we talking about money market funds in the context of financial stability? It's first the impact of the great financial crisis. Then I will talk to you about the European regulatory framework, so the money market fund regulation and its relevant provisions. And also importantly, the data we are getting now about money market funds through the reporting by money market funds to national competent authorities. And I will conclude with an overview of the EU money market fund industry. Now, on the impact of the great financial crisis. So again, why are we talking about money market funds during the financial crisis? So there are two aspects of money market funds and money markets which are relevant in this context. First, during the financial crisis, the instruments money market funds are investing in become volatile, their value reduces, and they also can become illiquid. Second, money market funds offer their investors daily redemption. So basically, like, you can get out of the money market fund at any time. Now, and this can create issues, as we have seen in the US, firstly, like in mid-September 2008, that's basically like one of the biggest money market funds, the Reserve Primary Fund, broke the buck. What does it mean? Basically, also the RPF promised its investors that basically would repay them at least kind of the nominal value, so $1 for $1 of nominal value of an instrument. So that didn't work anymore because values fell and many investors ran out. Now, and this created really big problems in the market. Having said that, basically, like, not all money market funds in the US were uniformly affected by the market strains in 2008. It was mostly funds with big institutional investors. Similarly, like in the EU, there were problems with money market funds in 2008. They were not as stark as basically like in the US, due kind of to the issues in the US subprime mortgage market, but still there were instances where funds had basically to stop or limit their redemptions, and there were also issues where basically the sponsors of money market funds, institutions behind the money market fund, did need to step in and provide support. Moving on. We saw basically, like, during the to summarize, like on the great financial crisis, we saw that with the support actions by sponsors in the US, but also in the EU, following the Lehman collapse and the kind of reverberations into the market, we also saw that central banks in Europe had to provide liquidity assistance to money market funds, and we have seen that basically, like, around 45 billion euros in EU money market funds were redeemed in the third quarter of 2008. So this may not seem a lot because, like, we are talking about a market of around $1 trillion, but in this type of instruments, if you basically like redeem like 5% of the value overall, like in a very short period of time, that becomes an issue and has also been concentrated in a few funds. Now, to deal with that situation in basically with money market funds, to get a better regulatory grip on them, first there were basically by the predecessor of ESMA, what is called CSAR. It established guidelines and first had a common definition of EU money market funds to establish some sort of minimum level playing fields. But it was only applied by 12 member states 1 year after they came into force, and there was a persistence of divergent national rules. So this was then basically the reason why the European Commission also started to develop the money market fund regulation, which was established in July 2017. So it was first and foremost also the creation of a European level playing field. Now, a few words on the money market fund regulation. So what is the scope of the money market fund regulation. First, it introduced a harmonized EU framework for funds, which basically look like they could be money market funds. So they have the characteristic of funds which correspond to those you would associate with an MMF. So it applies to collective investment undertakings, i.e. a fund, that first require authorization, either as an alternative investment fund under the Alternative Investment Fund Directive or as a UCITS. Second, in substance, they invest in short-term assets, and they also have basically as an objective, as a fund objective, offering returns which are in line with money market rates, or of preserving the value of the investment. So at least paying out the nominal value of the investments. So the main objectives of the money market fund regulation, they are a lot around the structure of money market funds, around the composition of the assets, around the valuation of the assets, around liquidity requirements, understanding the investor behavior, and also kind of reporting of information. So the key points there are in terms of the quality of the assets and the liquidity of the assets, reducing the risk of you could call it a liquidity crisis, but being affected by adverse market developments, which generally, especially in money markets with money market instruments, result in very low liquidity in those markets. Then looking at reducing the risk of contagion, first contagion, basically spreading within the money market fund sector, but also into the wider financial sector. So this is around rules on the composition of money market fund portfolios, what type of assets they can invest in, up to certain limits of how much they can invest in order to make the money market funds more resilient and limit potential contagion. Then looking at investor protection and transparency, there are rules around the frequency of valuation, how much money market funds need to value their assets, and the communication to investors, but also to supervisors, to regulators. Now, a bit more of a deep dive into the relevant provisions of the money market fund regulation. So we talk about what type of assets a fund can invest in, about the credit quality and liquidity of those assets, about diversification of the money market fund assets, further portfolio rules, and also a question around external support. So can money market funds be supported by the sponsor in times of crisis? So what are the eligible assets and what are money market funds not allowed to invest in? So eligible assets is an explicit list. And this is something which is quite unique in the investment fund space. It's really either it's part of that list or you can't invest into that type of asset. And I read down that list to you now. That's so first they can invest into money market instruments. That includes, and that's important, instruments which are issued or guaranteed by public bodies. So it's not only about the corporate market, but also about sovereign or government market or subnational government market. There are certain securitizations, and that's further defined in the regulation, and also asset-backed commercial papers. It can be deposits with credit institutions. It can be derivatives, but only for the purposes of hedging. And it's also about certain repurchase agreement and reverse repurchase agreement. And money market funds are quite big players in the repo market. And MMFs can also invest into units or shares of other MMFs. That's it. What can MMFs not do? They cannot do any short sales of money market instruments, securitizations, ABCPs, or units or other shares of other money market funds. They can have no direct or indirect exposure to equity or commodities. And they cannot enter into securities lending agreements or securities borrowing agreements. So they cannot, unlike other investment funds, can lend out the assets they have and earn a fee for that, or borrow securities from other funds, basically for their portfolio. And they are not allowed to borrow or lend cash. Now, in terms of credit quality and liquidity of assets. So MFs. They should or shall invest into high quality eligible assets. Eligible assets, we have talked about that, and now it's about the quality. And they can do an internal, MFs can also do an internal credit quality assessment of money market instruments. So there are first the requirement for the kind of duration, so kind of the investment term of these assets, the weighted average maturity, but also for the credit risk of the assets, and that varies depending on the type of MF, and we come back to that in a minute. There are also rules about the use of instruments. I've already spoken about the ban on derivatives other than hedging purposes, and also the rules around repo arrangements. And there are issues, there are questions around the liquidity management. So there are minimum daily and weekly liquidity thresholds. So how much of your assets can you liquidate within a day or a week? You need to know your investors and their cash needs, and that is important because money market funds, to a very large extent, are also used by institutional investors for cash management purposes. And they may have very specific needs for when they are holding money market funds and when they will need to kind of disinvest, and then may come back in very quickly later again, maybe for example, around balance sheet dates. And importantly, money market funds can also, under certain conditions, now limit redemption of money market of their fund shares when there are issues. So they can basically restrict to a certain extent or limit redemptions through gates, or fully suspend the redemption of the fund shares for a certain period of time. There are also rules in terms of diversification of the portfolio and concentration risks. So there's diversification requirements to reduce the counterparty risk so that they are not exposed too much to a certain counterparty. So that is from the credit risk perspective, but it's also important to have limited concentration by money market funds in investments issued by a same issuer to avoid potentially excessive influence by that issuer on the fund. So what are the rules? So there are 5%, it's a 5% limit of money market instruments, securitizations, asset-backed commercial papers issued by the same institution. There's a 10% limit in deposit you can make as an MMF with the same credit institution. There's a 15% limit in reverse repo per counterparty. There's also 50% limit in aggregate exposures with a single body for variable net asset value MMFs and low volatility net asset valuation net asset value MMFs. And there, importantly, there are exceptions for public assets for these kind of diversification concentration ratio limits. On the portfolio rules, there are basically like certain portfolio rules depending on each MMF type. So there are different rules for constant net asset value MMFs, different rules for low volatility NAV MMFs, and different rules for short-term variable NAV MMFs and standard variable NAV MMFs. And the goal is to reduce the risk out of the MMF portfolio and to strengthen the ability of money market funds to face redemption, and also basically like prevent the need for fire sales, to basically like prevent that assets have to be liquidated at heavily discounted prices. So and here you have kind of different rules in terms of the weighted average maturity of the portfolio assets, 60 days for most of the funds, kind of for short-term funds, and 6 months for the longer-term variable NAV MMFs. Also different rules for the weighted average life. You can see that, and there's also the maximum maturity of instrument, which differs between the short-term basically instruments and the standard VNAVs. And there's importantly also different rules in terms of how much of your assets you need to be liquid within a day or a week. So can be liquidated within a day or a week. And that's between 10% on a daily basis, between 10% for short-term CNAVs and short-term LVNAVs, and 7%, 7.5% for VNAVs. And on the weekly side, the minimum weekly liquid assets that ranges between 30% and 15%, depending on the structure of the MMF. On external support. So this is what we have seen basically like during the Great Financial Crisis, that MMFs had to be supported by their sponsors, or were supported. Now, as a principle, MMF shall not receive external support. And it means external support means a direct or indirect support offered to a money market fund by a third party, which includes the sponsor of MMF, and basically is intended for guaranteeing the liquidity of the money market fund or stabilizing the value of the money market fund. And there are different things in here. So this is what is forbidden. But we had kind of another difficult market situation during the COVID crisis, and there had to be some, and it was important to clarify what that means. So you can still, in a normal course of a of your investment and action as an MMF, you can still enter into transactions with affiliated or related parties. So, e.g., you could basically, like, credit institutions can purchase short-term asset held by MMFs out of their group within the limit of the concentration and diversification rules. But it is clear that basically, like, kind of these kind of transactions are not allowed to be intended to guarantee the liquidity of an MMF or stabilize the value of an MMF. And this is really important, those clarifications. Now, important element of the money market fund regulation is also transparency about what MMFs do. And this is also then the reporting to the national competent authorities, to their supervisors. And there, the general principle is, in terms of frequency, that basically, like, if an MMF is large, and that's defined as more than 100 million euros of assets under management, then the reporting has to be quarterly. And if the MMF is small, below 100 million assets, the reporting is annually. And the content, I will talk you through that now. So what has to be reported? First, it's really the general characteristics of the fund, like kind of the manager, who is the manager, like where is the domicile, and so on. It's type and the characteristics of the money market fund. Is it a standard or short-term variable NAV fund, a constant NAV fund, or a low volatility NAV fund? There have to be information on the share classes within the fund. There are portfolio indicators of the money market fund. We've talked about that, like kind of the size, the weekly, the liquidity side, and the kind of maturity side. Then, and we'll get back to that in another lecture in more detail, it's about stress tests on money market funds. MMFs have to carry out stress tests, and they have to report the stress tests of the money market fund to their supervisors, and also the proposed actions they want to take about that. And there has to be detailed information on the assets held in the portfolio of the MMF. This is really detailed portfolio reporting. It has to be, they have to report the characteristics of each of the assets, kind of the name of the asset, issue category, type, maturity, you name it. And they also have to provide information on the liabilities of the MMF. Liabilities also, it's basically like their investors which hold the fund shares. So it's the country where the investor is established, the type of investor, is it an institutional investor, is it a bank, is it a pension fund, is it a corporate, and also details about the subscription and redemption activity. And now a few points about how does the MMF industry in the EU look like. So in terms of overview of the EU money market fund market, I'll give you a few basically like key statistics here. So we see around 500 MMFs authorized in the EU, and they are concentrated in three countries, in Luxembourg, Ireland, and France. And overall, we have around 1.4 trillion of euros of MMF assets at the end of 2021. In terms of three kind of main countries, they also quite different in terms of types of funds which are basically located there. In Luxembourg and Ireland, these are the main domiciles for constant value, constant NAV MMFs and low volatility NAV MMFs. France is the main domicile for variable NAV MMFs. And what you also see in terms of denomination of the assets in the left chart is that most EU MMFs are denominated in non-EU currencies. So it's a minority, like around 40% in euros, around 30% in US dollars, and around 20% in British pounds. In terms of exposures, there is a basically like dominant exposure to financials. So a bit more than half of MMI instruments MMFs invest in are issued by credit institutions. And there's limited exposure to non-financial entities, so around 10%. Public instruments and public sovereign instruments account for around 18% of MMF investments, and we have other types of assets, so mostly repos and deposits, which are around 22% of assets. And when we're looking at investors, basically, like we see a dominant role of non-EU investors. So this is especially true for well, but this varies between issuer countries. So this varies between Luxembourg, Ireland, and France. In Luxembourg and Ireland, they mostly cater to non-EU investors. You see in Luxembourg nearly 60%, for Ireland more than 3/4 of the investors. And this includes a lot of UK investors, around 57% for Luxembourg and 33% for Ireland, and also a lot of US investors, 10% and 8% respectively. Whereas France is mainly domestic and EU investors, and a large percentage of unknown category where we don't know where the investors are coming from. And basically, in terms of investor types, we are basically like looking at other financials, which includes other funds, for around 40%, and then around 10% of insurance companies and pension funds, and 9% banks, and corporates, they own around 20%. I want to quickly, before I close, talk a bit about one specific type of assets of EU money market funds, around sovereign debt, because that can be a bit of a interesting issue, because kind of the concentration limits and liquidity rules around these assets are waived. Now, how much of basically like EU MMFs invest around 200 billion euros in sovereign debt, and this is around this compares to around 1.4 trillion of total assets, and around 150 billion of that is invested into non-EU sovereign debt, so which is around so it's around 70%, and that includes mostly the US and the UK. In terms of MMF types, it's quite different in terms whether they invest into sovereign debt or not. So most sovereign debt exposures relate to CNAVs, and that's around 2/3, and then around 16% for low volatility NAV funds, and also like variable NAV funds have around 30% of exposures. Interestingly, UK sovereign exposure is mostly held by LVNAVs. And CNAVs have, if you look at the right-hand chart, they really have a really negligible exposure to EU sovereign debt. It's mostly non-EU sovereign debt. Whereas kind of LVNAVs have more exposure to EU sovereign debt, around like 1/3 of their sovereign debt exposure, whereas VNAVs mostly have kind of exposures to kind of sovereign debt issued by EU countries. And with that, I hope I have given you a good overview of the money market fund industry. And here you have a couple of further readings if you want to dig deeper into the topic. Thank you very much for your attention.